David S. Rose, 50% of startups fail. So if someone comes to you with a startup idea, how do you know whether or not it's going to be profitable?
You don't. You assume that 50% of the time it's going to fail, because they do.
Well, there's lots of opportunities out there now. There's Kickstarter, other ways for people to find funding from the crowd and the cloud. What are the best ways for people, if they're interested in being an angel, to go out and find those opportunities?
Well, the first thing they should do is read the book that I just wrote, which is the handbook as to how to be an angel investor. But then there are online sites, an increasing number of them now, that list opportunities that are available for investments, legitimate ones. So for example, Gust, which is the platform that I started, has nearly 300,000 companies that are looking for funding on there. On the other side, it's used by angel investors as the tool for them to find opportunities and collaborate with others.
But unlike public companies where you can look at multiples and price to sales, price to earnings, profits, you can't do this with startups. So what kind of metrics do you look for other than, wow, that's a pretty cool idea?
Well, that's the one thing you don't. It's a pretty cool idea. And as you point out, you can't look at metrics because there are no metrics. So what you do is you try and get rid of the 80% of ideas that really shouldn't be funded, and you try and come down to the 20% that have a shot, and then you try and invest in them. And that means you typically look for traction. Has something happened? Have they got some product market fit at this point? You're investing very early on in the life cycle of a company, so it's very, very risky.
Should you chase what's hot right now? You look at what's coming public. The IPO market is full of cloud companies for every single part of the digital economy. Is it smart to say, here, take my money, there's a cloud company?
No, you don't chase what's hot, because angel investors typically hold companies for 9 years in the United States. You're going to be in this for a long time. It's totally illiquid, and so the trick is to invest in a lot of companies. Do your best to get rid of the bad ones, and invest in as many of the good ones, when you think could be good, as you can. At least 20 companies.
So what are you seeing right now that you like that we might see in 9 years come public across the street at the New York Stock Exchange?
Things where you're seeing increasing technology applied to markets that are non-tech markets. Take, for example, bicycle sharing. The first generation bicycle sharing systems were a bicycle with a lock that was locked to a lamppost. The second generation, what we now have in places like New York City and Paris, had smart hubs where the bike got locked into a hub and you put in your credit card and released it from the hub, drove it to another hub, and locked it up. One of the latest companies I've invested in is called Social Bicycles. It's a third generation smart bike system with all the intelligence on the bike. It's got a computer, it's got GPS, it's got 4G, it's got the lock built into the bike, so you can look on your iPhone, see where the nearest bike is, unlock it on your iPhone, and then drive it to wherever you want to drive it, and then lock it up to a bike rack.
It's as easy as riding a bike.
You got it.
Congratulations on the book, Angel Investing, David S. Rose.
Thank you very much.
And thank you for watching The Street.